Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment Workshops, and we're doing the entry-level workshop into Introduction into Life Insurance. And all this week, we're introducing you into Variable Universal Life. And today, we're going to be using the Lincoln Benefit software, so it's very important that you go out to their site, www.lblsales.com/ETW. Lincoln Benefit's our sponsor, and of course, they're an Allstate company. And when you go out there, you're going to see this actual picture will come up. You'll be on this page. Eclipse Illustration Software Installer. You'll see Run Installer. You'll hit it, and it'll install the software, and you'll go page by page with us through the system. It really helps your tutorial, your learning process, and I totally recommend this. We chose this software because we thought it was the easiest software to learn life insurance on, and it's a great platform. So again, www.lblsales.com/ETW and download the software and go page by page with us. Also, another thing our sponsors doing, Lincoln Benefit, they're allowing us to go out to this site, and you see that's the bottom of your screen right now, and that address is also in our search engine optimization description, so you can go ahead and cut and paste. It's kind of long, I know, but when you get it, you'll be able to come out here, and on this area, you're going to see a thing called the Facts of Your Life booklet. It's a great data collection piece. It either can come electronically or hard copy book, and also in here, we have our prospecting letters and prospecting postcards. So if you're saying, wow, I really need to figure out a marketing campaign, how do I talk to retail clients? Those are already pre-done, ready to go. Just remember, if you're FINRA licensed, you're going to have to get your broker-dealer approval, or if you work in a regular life insurance agency, you'll have to get somebody in your office to approve it, your use of it. But they're all excellent, very basic. You should be able to use these pretty much at will. And then another thing I just want to point out always, if you ever miss any of our shows, whether it's edutainment workshops or you're saying, boy, I've heard about the Business Insurance Zone, that's it right on our homepage, www.brokersalliance.com. You can watch any of those shows, including our workshops. They're all on the on-demand videos. Hit that button, it'll put you right into our archives, and you'll be able to utilize all the things we talk about. You'll be able to say, hey, I'm going to catch up on Steve's classes. And remember, just a little heads up, you need to go back and go to class 1 and start over. If you're coming in here now, you're 2/3 through it, and we really laid out some basic ideas. And one of the basic ideas is we have a basic life manual and a vocabulary page. If you want to order it, you can have it absolutely free. Just write me, thebiz@brokersalliance.com. That's the biz, THEBIZ, at brokersalliance.com, and we'll send it to you absolutely free. Now, let's get into our software for Lincoln Benefit Life, and hopefully now you've downloaded it so that you can go page by page with us. And I've already selected the variable contract they're using, and they call their Variable Universal Life contract the Total Accumulator, right? So when I'm looking at this, I'm on their first page, and again, if you've walked through us on our current assumption, our guaranteed UL term, you've already been on this and you've seen a little bit of this, and hopefully by now you're becoming accustomed with Lincoln Benefit software, which, as I've said before, is a great tutorial. Now, in this case, anytime I have my birth date when I'm going to plug in a number, I'd rather use the birth date than the actual age. So if you know that birthday, that's even better. So I'm looking at a person here, and let's just go ahead and let's see if it'll let me do this. Let's go back a few years. Okay. And what I'm going to do is I'm going to keep this 58-year-old male, and as you can see, I have several options here. Lincoln gives me most of the options that are out there right now. Super preferred non-smoker, standard smoker, preferred smoker, and standard smoker. Now, all these are classifications built and based on your health classification, and of course that goes through an underwriting process. If your client was really buying this for indemnification and they were substandard or an impaired risk, I don't know if Variable Universal Life would really be appropriate because the expense loads would really be prohibitive in my view. But if you did and you had a substandard case, you could actually put the table ratings in, or if you had flat extras, temporary or permanent, you could put those in as well. It's very easy to do. Then what you want to do is, if you're buying this for indemnification, you can ask for a specified amount, but it also gives you other options. You can get the specified amount, and remember, yesterday I talked about, when we were talking about the spreadsheet grids, you could actually have 2 sets of guarantees, extended coverage guarantee and full guaranteed lifetime. So you have to have choices here between what you want to do if it's an indemnification issue. Do you want to pay a little bit more so that no matter what happens in the market, at least you have death benefit coverage? Now remember, you could have no cash. So they're just doing this required premium for their guaranteed selections, either lifetime or a limited benefit. I just want to keep that in mind. And remember, if you're doing this for death benefit or for income, you're going to select the minimum death benefit and make sure that you have the modified endowment contract checked. And that's, I think, on the next page. I'll get to that in a second. You have 2 options. One is option 1, which in their language and most people in the industry, option 1 is level death benefit, and option 2 is increasing death benefit. And so you'll want to choose those, and if you're doing income, you'll want to test both out to see which one delivers the best possible income scenario. And of course, we do that for you so you don't have to hassle that and your learning experience. It also gives you the ability to put on a term rider amount, but again, to me, if you're going to be doing term riders, you shouldn't be doing a VUL contract. So, but just looking at it, variable, you have some ideas, some selections here. Now what I want to do is I want to go out to the illustration rates. And we're going to get into this much more as we head down the week. We're going to get into this issue of what do I illustrate? Well, it shows me all my historical data on all my separate accounts. But I'm not really sure I want to do that today, so I'm going to park that for next week. I could put in a maximum interest rate or interest crediting rate of 12%. I don't recommend that. I think you need to be topping out at 8%, somewhere in that vicinity for VUL. But if you wanted to, you could do it. I don't push this, but if you wanted to be fair to the client, and I think you do, you'd want to be able to say whatever my model is, and I take out the last 20 years, or if the fund's been inception, hopefully has been that long, and try to take the longest period and see what that number is, and then blend your accounts and then plug that number in so that it matches. It's pretty bad to show 10 and 12% when you have no historical evidence for this going 20, 25, 30 years out. So to be fair for the client and make the illustration look a little bit like this, and we're going to show you something Friday where you actually can plug in the last 20 or 30 years to kind of give you an idea of good years and bad years. So when you choose a number, I'm recommending 8%. You could, though, top out at 12. So let's go back down, and I want to look at report options. Now, when I'm looking at variable universal life, there are a lot of schedules here, and I want to be able to pick in my report. I can have a customized cover page. I kind of like that. But if you start writing things on your customized pages, remember, and you're making your own disclaimers, your own things, you're going to have your broker-dealer compliance department sign off on it. So when you do a basic thing, client name, your actual address, and everything else that's in your standard approved contact information, that's about it. Anything beyond that, explaining if this is in a retirement income scenario, supplemental income, whatever, that probably is going to have to hit compliance. So don't be too much of a wordsmith here. Go ahead and keep it basic. You also can put, and I like this, I put the classification requirements. When I'm showing the illustration, I want to say, here's what we think the underwriting is going to be, but I show them the requirements of what I've chosen for this client as what we think his health classification is. And I also put in the internal rate of return. If you really want to make friends in the fiduciary market, whether it's a CPA, tax attorney, or a trust officer, you're going to be putting in the internal rate of return, which will calibrate, is this a good deal from a death benefit point of view or a cash value accumulation point of view? I always like to put the internal rate of return in. And thing that people don't do, and I don't know why, because this really shows exactly where the expense loads are coming out. I like to print the expense report. Now, if you're really an aficionado and you want a 60, 70-page report, go ahead and push monthly. Every expense load will be managed on a monthly basis. But I think annual is fine. And if you're paying it by the month, if you want to just be a purist, go ahead and hit it. It's just going to be a very large proposal. And you have a choice here. Do you want to use current company practice, cost of insurance, or do you want to use the maximum they could charge? I generally show current because most carriers have been pretty good about hanging pretty close to their current assumptions, and we're going to kind of go that way because the contractual imperatives on COIs are just through the roof. They're just there to protect them. Ultimately, they could move it. Could they change it from current company practice to guarantees? Absolutely, they could do it. Now, some contracts actually offer COI, or cost of insurance bailouts. If they try to jack the rates in a certain period of time, you can walk without a surrender charge. I think that shows good actuarial faith on the carrier's part. I like that. I appreciate that. Now, what we're going to do now is I'm just going to run a basic illustration. Again, that warning that just came up says, hey, are you security licensed? Well, I am, and hopefully if you're selling this or even talking about it. And that brings me up to another little quick regulatory issue. There are some states that come to my mind now that actually require you to be security licensed if you are recommending a client take a security and then actually cash out of that security and use it for a non-FINRA insurance product. Just be advised that some states now require licensing to discuss and make recommendations. If your recommendation is in a state and you're not FINRA licensed, you could be exposing yourself to some kind of liability. So just a little heads up there. Well, we're on the front page, and let's see if I can just do this real fast. And it's showing what I put in here, my male 58 preferred elite, in great shape. And let's just go up here to, it shows here my current charges, my maximum charges, this is all the disclaimers, and everything I'm willing to do up to age 121. It also discusses my premium outlay, my net distributions, what's my real number, and then my policy values. And it walks through the net surrender value, the regular surrender cost. All these items you should at least read once in your life just so you can say, okay, I'm familiar with this. Some of this is also in our vocabulary that we give away, which you can get it again at brokersalliance.com. And then also, many carriers have went to this overloan protection rider, and they use it, in this case, Lincoln Benefit is all years. And this is going to protect you. So if you're using this for income and you overloan the contract, it'll make adjustments for you so that it doesn't default. If your contract lapsed or defaulted, there wasn't enough cash in there, and you actually took out all that policy gain, you'd actually have a phantom income tax, ordinary income tax, in the year that this contract went down or surrendered or lapsed. So it's very important to look at the carrier's provision. What does it cost for this value? What do they charge for this? And illustrate this so that you can make sure that you have overloan protection, especially in income scenarios. They also give you different riders that you can do: terminal illness, permanent confinement. And remember, these also appear on current company, or current assumption UL and guaranteed UL. And the reason I bring that up is because if you're going to sell this for death benefit and have associated morbidity riders on here, like illness, critical illness, long-term care, things of that nature, I don't think this is the way to do it because it's a very expensive contract to do this with. But if you understand investment posture and you're in it for the long haul, because buying contracts like this, in my view, are long haul items. So you can look at also all the variable investment options. And I mean, tomorrow and Friday, we're going to get into all these possible options. So there's quite a bit here, and we want to make sure that you understand it. And one of the descriptions I like is you have each sub-account has its own unique risks. If you take each one, some are going to be more conservative, some are going to be a little more risky, and if you had to actually measure the client's risk, I like to get the client's tolerance done first, see what their kind of risk is, and then stay away from funds that I know have higher beta risk or exposure. And you can go to those sub-account managers and they'll tell you where they fall on some of this, and I'd like to know that because I want to make sure that I'm matching my client's suitability with the risk that's in each of these sub-accounts. When I look at this, and we're going to be looking at this tomorrow, we're going to be looking at all the contracts, all the illustration numbers, and look at some of these premiums that are there so that we can understand what are we getting ourselves into, how much will it cost, because I think when you want to measure something like this, I'm trying to measure the internal rate of return. Is this a good deal or not a good deal? And try to look at the idea of what the contract is showing. So when I put money in, on one point before we take off and end our class today, assume gross rate at 10%. Notice that after I take out my asset allocation charge, there's my actual net rate crediting. The gross may be 10%, but in this model, it's costing me, it's actually 9.33, so I'm spending 67 basis points charge to be in this asset allocation fund. This just happens to be a weighted age group.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance. and sponsored by Lincoln Benefit Life, an Allstate company.